Yeah. Okay, let's get started. So, yeah, you know the basic smart money concepts, right? The basics like what order blocks are, what liquidity is, imbalances, and all of that stuff. Yeah.
Yeah.
Hope you know that. Yeah. So let's start with this now. Now, do you know about the protected highs and the lows, or is the strong highs and lows? Okay, so let me show you. Something like this is what we call a strong high. Okay, something like this is what we call a strong high. So what you want to see is liquidity being taken out and structure getting broken. So once this happens, we say that this high right here is a strong high. Now I'll show you this will be something very important when we mark out ranges and all of that. Okay, so that's a strong high, and same way, this right here will be a strong low or else a protected low. So what we want to see is liquidity being taken out from a previous low and then structure being broken. So once this happens, this will be a strong low. Okay, now another thing is now when I say liquidity has to be taken out, okay, when I say liquidity has to be taken out, it doesn't have to be like now most people would assume liquidity is equal highs, right? Yeah, this is liquidity, or it's maybe trend lines. Okay, yeah, this could also be liquid, but it doesn't have to be this all the time because do you know the three candle formation for a swing high and a swing low? Yeah, the three candle
Like you to
formation.
go.
Let me
Yeah,
show
I'd
you.
like you to go through it again, please. The three
Yeah,
candle
let me show you.
formation. Yes,
Yeah,
please.
let me show you.
Thank
Okay,
you.
so when I say a swing high, what we want to see now, it's just any three candles. Okay, it's any three candles. So what we want to see is, let me show you a clear example. Yeah, something like this. Something like this is what we want to see. Like let's say we pick these three candles. So what we want to see is a lower high to the left, a lower high to the right, and
Yeah.
the middle candle will turn into your swing high. Okay, the middle candle will be your swing high. So see, even this right here is a swing high. Why? We have a lower high to the left, a lower high to the right. So this will be a swing high. Okay, that little wick right here will be a swing high. See, even this is swing high, a lower high to the left,
Sorry,
lower high to the
Udara.
right.
Udara.
Yeah,
The
yeah.
previous one you just mentioned now. Can
This
you
one.
show me? Yeah, this one. Yeah.
Okay.
Where's the lower one
Yeah.
to the left?
Let me show you. See this? Lower high
Okay.
to the left, a lower high to the right. Just three candles. Okay, we're only
Oh,
choosing
okay.
three candles. One, this one, and then this one.
Okay.
Okay, so if we pick these three candles, we can see that this one is higher than the both of them, right? Higher than the left one and higher than the right one. So which means this will turn into a swing high. Simple. Okay, so it's nothing to overthink. It's something very simple, but it's very important because above every single swing high in the market, there will be buy stops resting. Okay, there will be buy stops resting above every single swing high in the market. Okay, so breakout traders will be placing their buy stops above these swing highs. Okay, so let's talk about that later. And yeah, same thing, like what's the swing low? Okay, what's the swing low? A three candle formation. Let's see a clear example. Let's see a nice one. Where do we have clear ones? Yeah, in all these areas, we do have swing lows. I'm trying to show you a clear one that way you'll understand it better.
Okay.
Um, let's see. Where do we have it? Yeah, here we go. A very perfect example. This is what we call a swing low. Okay, so what we want to see is now in this case, the opposite of what we talked about earlier. A
Yeah.
higher low to the left, a higher low to the right, and the middle candle will turn into your swing low. Okay, the middle candle will turn into your swing low. So this right here is what we call a swing low. Now, once again, this formation is also important because this is where the breakout traders place their sell stops at. Okay, so below every single swing low in the market, there will be sell stops resting. Like look at this, for example. What did this wick do? Okay, what did this week do? Cleared out sell stops.
Yeah.
See that? So what they did was they took out all of the sell stops that were resting below these lows, and then they went in the opposite direction. Okay, they go in the opposite direction. So that's what they do all the time, from buy stops to sell stops. You know, after taking out this low right here, where will they go next? After taking out sell stops, they'll always go into buy
But
stops.
yeah.
Yeah. So they take that out and then they give you another pullback. Okay. So now when I say liquidity has to be taken out, okay, when I say liquidity has to be taken out, all we want to see is a run above a swing high and a break of a swing low. Okay, a break of a swing low. Now remember, for this liquidity grab, for this top hunt, like we don't care if it happened with a wick, with a body or whatever, but this break right here must happen with a body closing. Okay, we're not going to consider wick breaks to be a breakout structure. It has to always be with a body. Okay, a body has to close below these lows. Only then we will consider this as a breakout structure. Okay, only then it would be a breakout structure. So same thing in here. It has to run below a swing low
Yeah.
and give you a break of a swing high. Okay, a candle closing. So that is what we call a strong high and a strong low. I'll show you examples later. Yeah.
Sorry, Udara. To
Yeah.
buttress what you've just said now. Now,
Okay.
if I've got an example, for example, in GU today, If I look at my chart, due today on the 29th, I think in London time around 3:30.
Okay.
Or is it around 5?
What time frame was it? Yeah, okay. What time frame was it?
You can check M15 or M30.
Okay. Yeah.
Yeah, there was a weak break. But on the line charts, it shows like it's a break of structure, a bullish break of
Yeah,
structure.
now I'll show you. Okay, we'll be using the line chart more now. Okay, we'll be using the line chart more. That's why I see. That's why I have it marked. We have it in here. Okay, so we'll be using the line chart more. But don't worry, like we're not gonna get trapped with all of these moves because I'll show you once we go into ranges and all of that, you'll understand like what they're doing in these areas. Okay, you will understand what they're doing. But yeah, like days like this, I prefer staying out of the market because nothing was clear. No setups. So if there are no setups, we can't force anything, right? We cannot force anything. Okay, so if the setup isn't clear, like if the coast is not clear, we must learn to stay out. Okay, so I'll show you. I'll talk about those stuff later. But let's go through the theoretical stuff first. Okay, so this is what we call a strong high and a strong low. Now, yeah, now you might have seen how these inducement patterns and all of those stuff works, right? So let's say we had a stop hunt, a breakout structure, and then the market might give you a little retracement, and let's say we got another break like this. So now if you just look at basic market structure, what do we have? We have a high, right? We have, and then we got this lower low, right? A lower high and another lower low down here. So now this is just basic market structure. So we know that if price is creating lower highs and lower lows, it's bearish, right? It is bearish.
Yeah.
So now if someone wants to re-enter, what will they expect? Anyone would expect another lower high and a lower low, right? So they'll be expecting maybe a lower high or something to form in these areas. So what will smart money traders do? Smart money traders will start marking out order blocks in these areas, right? Yeah. They start marking out order blocks here. Like some of them will right away set their limits here, stop loss above that, and they'll target lower prices. Okay, so some people would do this. Some people will wait until price gets inside of this, maybe wait for a lower time frame break and then enter. Okay, they will also do that. But yeah, now not only smart money traders are doing this, right? Who else? We have the supply and demand traders, right? Supply and demand traders might tell you that this is supply that broke the structure. Okay, the supply that broke structure, or else maybe a rally, base, and a drop, right? So supply and demand traders will also set their limits here, maybe with their stop loss above that high. Okay, but not only smart money and supply demand, who else do we have? We have the trend line traders, right? Now, what are the trend line traders doing? Okay, they are also expecting pretty much the same thing, a retracement back into the trend line and then the drop. Okay, so this is what they are expecting. So once it gets back into the trend line, they'll sell it with their stop loss above the previous touch into the trend line, and they'll target lower prices. Okay, so that is what the trend line traders would do. Now, not only trend lines, what is this? Break and retest, right? Yeah. Break and retest. So what will they do? Maybe wait for that bearish engulfing candle to form, use that as a confirmation, sell it, stop loss above that high. Okay, so that is what the break and retest traders would do. Not only break and retest, this right is what we call a flip zone, right? Because a broken support will turn into resistance. Okay, a broken support will turn into resistance. So maybe they'll also wait for that bearish engulfing candle to form. And once that forms, they'll sell it with a stop loss above that high. Okay, and then finally, since this high right here is a swing high, what do we have above that high? Buy stops, right? We have buy stops. Yeah, we have a pool of liquidity resting above that high. Now, yeah, now if you know ICT, yeah, you might obviously. So ICT tells you that liquidity is something like a magnet. Okay, liquidity is something like a magnet. So let's say like this. Okay, this is a magnet. And then price. Okay, what is that? Price is like a paperclip. Okay, price is like a paperclip. What happens? It always draws towards the magnet, right? Yeah. It always draws towards the magnet. This is what we know. So we have to always know where the draw on liquidity is. Okay, we have to always know where the draw on liquidity is. So now in this bit of price action, where is the most amount of liquidity? It's right above that high, right? Yeah. Right above that high. So now as smart money traders, if we do something like this, what are we doing? We're doing the same thing as a retail trader. Yeah, we are retail traders, but we're not using those concepts, right? But if we do this, we're placing the stop loss at the same area where they would place their stop loss at, because now see, they're entering from a trend line, we're just entering from an order block. So the only difference is the strategy. Okay, nothing else. The stop loss is at the same place. Okay, so what we should first do is we must spot the liquidity. Okay, once we spot this liquidity, now we know that it's not safe for us to look for anything around here. So what we do is we look for something above that. Okay, we're going to look for something above that. Now remember, for this right here, okay, now this is the tricky part. Okay, this is the tricky part. So this could be an order block. Okay, this could be an order block. This could be a breaker block. Okay, so you know what breaker blocks are, right? Yeah, This could be a break block. I'll show you examples. And then this could be an imbalance, or else, most importantly, this could be a rejection block. Okay, this would be a rejection block. Now, let's put imbalances aside. Okay, let's put imbalances aside. We're not going to focus on that a lot. But remember, it's just one simple point of interest that we're looking at. What is that? That's the opening prices of the candles. Okay, simply, we're going to focus a lot on, actually, it's not the opening price, it's the closing prices of the candles. Okay, so yeah, the closing price of the previous candle is the opening price of
The
this candle, so
closing
it could be
price.
whatever.
Is
Yeah,
it
I'll
the
show you.
closing or the opening?
Both of them, like most of the time, I'll tell you the most probable thing to do is use the closing price. Okay, use the closing price of the previous candle. Let me show you. I'll show you examples. Okay, so yeah, this could be an order block, a breaker block, a rejection block, or it's an imbalance. So now if you put if you put imbalances aside, we're simply focusing on the closing prices of the candles. Okay, we're focusing on the closing prices of the candles. That is what we are focusing on. Okay, so yeah. So now let me show you. Now let me show you. Now, and the next thing is now order blocks, breaker blocks, rejection block. It's the same thing. Okay, it is the same thing, but like yeah, it's the same closing price, but once we switch time frames, you will get a different view of it. Okay, you're gonna get a different view of it. So let me show you. Now,
Okay.
first thing, yeah, let me show you. So yeah, now firstly, you know how order blocks are formed, right? You know how order blocks and breaker blocks are formed. So let's
Yeah.
directly dive into it. Now, most people would think now, yeah, let's go through that quickly. Now, most people would assume that an order block is a candle, right? An order block is a zone. No, it's not that. Okay, an order block is a specific price level. So what is that price level? So let me show you. Now, first thing, let's say maybe we had liquidity, equal highs. Now, what would retail traders assume? Retail traders would assume that a double top is a sign of a reversal, right? A double top is a sign of a reversal. Or is this the M formation and all of that stuff, or is resistance and all of that? So they might think that it is a sign of a reversal. Okay, they might think that it's a sign of a reversal. So what they do is, once this breaks, they'll expect a move like this. Right? They'll be expecting something like this. So what will they do? Once it gets here, once it gets into these areas, they'll sell it, stop loss above the double top, and they'll target lower prices. But smart money, okay, smart money knows this. Smart money knows that there's a pool of liquidity resting above those equal highs. So what will smart money do? They're going to force a move now. Okay, they're going to start placing buy orders in these areas. They'll place buy orders, they'll knock out, like they'll take out everyone that placed their stop loss above that high, and then they'll push price down. Okay, so what is actually the order block? Okay, and now the order block will be where the buying started from. Okay, where did the buy start from in order to do this manipulation? Now, why do we call it an order block actually? Now, it's like this. Now, this move to the upside was a forced move, right? This was forced by smart money. But when a buy will only profit when the market is moving up, right? But the market is moving down now. So now what's happening is smart money is now in a drawdown, right? The market makers are whoever that pushed this price to the upside is now in a drawdown because now they have their opened buy positions in these areas, but now the market is moving down. Okay, so what they do is now they do not use stop losses like us. Okay, their pockets are deep. So what they do is they will push price back up into that area where they earlier bought it from. So this is what we call a mitigation, mitigate out of their loss and then push price back down. Okay, so an order block will be this price level where the price level they used to buy it from. Now you might be wondering, okay, so we might have many levels, right? We might have many levels. So I'll show you how to spot the right level. Okay, I'll show you how to spot the right level at least 85% of the time. Okay, so we'll be always going into the higher time frame. So now first thing, now let me show you order blocks, breaker blocks, rejection blocks, all of that stuff. Okay, so let's see. Here we have a nice example.
Yeah.
See that this right here is simply what we call a rejection block. This is what we call a rejection block. So the closing price of the bullish candle or is the opening price of the bearish candle. This right here is what we call a rejection block. And remember, there's a simple rule to it. Okay, there's a simple rule to it. Let's say maybe there is a candle or a wick that has tapped into it like this. Okay, let's say we have a wick or something that has tapped into it like this. So we are not going to use this level anymore. Okay, we're only going to use fresh levels like this. Okay, levels like this. So now look at this. The opening price of the bullish candle is an order block, right? The last push up before the push down. So where did this price tap into? Right into this one. See that?
Yeah.
Opening price or is the closing price of this one. Okay, so price tapped right into this. So the closing price of the closing price of this bullish candle is your order block or is the opening price of this one. And yeah, the opening price of the bearish candle can be your rejection block. Okay, so same thing. Look at this one. Even this. Okay, even this is a point of interest. Even this one. Even this one. All these areas are POIs, but we're not going to use all of them. Okay, we're only going to use the ones that has liquidity below it. So that's why we first talked about this one, right? That is why we first came into this example because now we know that there's a pool of liquidity resting in here, right? So first thing we do is like, we're not going to just directly just mark out a rejection block as an opening price and then wait until price gets there. No, first we spot the liquidity, and only above that we look for a point of interest. Okay, I'll show you examples. See, like even in here, this one tapped right into it. Maybe there's some liquidity in here. Okay, so let me show you some clear examples. Yeah, now look at this one. This right here is what we call the order block. Okay, not the whole candle, not the whole candle like this, only the opening price of the bullish candle. Okay, the opening price of the bullish candle. This will be your order block. Okay, so we're not going to mark up boxes. No, we're only going to just draw a line, because I told you an order block is a specific price level. So this right here will be that line. Okay, the opening price. So now if you go to lower time frames, now that's why I told you it's the same thing. Order blocks, breaker blocks, rejection blocks, whatever it is the same thing. But once you switch time frames, you'll get a different view of it. Now see, the 4-hour order block is what on the 1 hour time frame it is a breaker block. Yeah. On the 1 hour time frame, it is a breaker block. So you can even refine that one into this rejection block. See, so you can just go from time frame to time frame. So what
Sorry,
happens?
okay. On the topic of rejection block, what defines, what makes, like, does he have to grab liquidity for it to be?
It doesn't have to grab liquidity. Okay, main thing is it has to have liquidity below it. Okay, it has to have liquidity below it. That's the main thing. Now remember, like, we're not going to use all of the rejection blocks. We're only going to use the ones that are in line with the current market direction. Okay, so once we go into ranges and all of that, let's talk about direction and all of that later. But yeah, we're only going to use the ones that are in line with the current market direction and has liquidity below it. Like for example, this one. Okay, we clearly have equal highs and all of that, right? Our smart money traders, so supply and demand traders, everyone will get trapped, right? Look at the supply. Let's look at that order block. Many are trying to sell it here with the stop loss above that high, but we sell from above it. Okay, so yeah, all the liquidity gets taken out right into this one. Yeah.
What qualifies this one now as the rejection block? Why?
Which one?
This.
Now it's like this. Yeah. Now you saw how we refined it, right? Like we did not just directly chose this one. Okay. First we looked into the higher time frames, 4-hour order block, refined into the 1 hour rejection block like this. A slight refinement. That's it. Okay. And also this is a strong high. Why is it a strong high? Liquidity grabbed.
Yeah.
Structure broken.
Yeah.
Okay, so yeah, we have a strong high. We have the high time frame point of interest. That's our 4-hour rejection block. I'm sorry, 4-hour order block that is refined here. And most importantly, we have liquidity below it. And the final factor we take into consideration is timing. So timing is perfect. This is London Open. So this was February. So you can see if I set it to London time right at 8 a.m. Okay, so timing, we're going to focus on all of that. Okay, we're going to focus on timing. We're going to focus on strong highs and lows, high time frame POIs and all of that. Okay, so yeah, that is a simple example. Let me show you some clear ones. Okay, mainly the rejection blocks because it's very important. Let's see some more. Yeah, look at this one. This was clean. Yeah, I'm only showing you rejection blocks. Okay, let's talk about structure, ranges, direction, and all of that later. Okay, now look at this. Yeah, if we go into the H1, and you'll also see that we're not going to use the 1 minute. Okay, let me just delete that. We're not going to use the 1 minute. These are the only time frames that we're going to use. Okay, now don't worry. Even while using this, we will have 2 to 5 pip stop losses only, nothing more than that. Okay, so I'll show you how to get this tight stop loss from the 1 hour and the 4 hour itself, because you know how messy the lower time frames are, right? It's so much noise. Okay, so much noise. So yeah, like we're not the algorithm, right? We do not know how to deal with it like very precisely. So the best thing to do is we're going to focus on these time frames and we'll get sniper entries and you'll see all of that. Okay, I'll show you. So yeah, now what is this? A strong high, right? Why? Liquidity taken out and structure broken. Okay, like now in this market, of course, there is no reason for you to buy, right? Because look at this one. The major breakout structure is what? Bearish.
Bearish, yeah.
Right? The major breakout structure is bearish. So when the major breakout structure is bearish, what are you going to focus on? Strong lows? No, you're going to focus on strong highs. Okay, because those are the ones that are in line with the direction. Okay, so now we know that major breakout structure bearish, counter trend also turns bearish. So then we call it a range expansion. Let's talk about that later. So this turns into a strong high. Okay, so on the strong high, remember, once a strong high is created, we always look into the higher time frames to see what our point of interest is. Okay, now look at this. On the strong high of the 1 hour, what do we have on the 4 hour? A rejection block. Okay, so now we have everything. We have everything we need. Strong high time frame point of interest, and most importantly, liquidity sitting below it. Can you see that? Yeah. We have liquidity below it, a swing high, not just a random swing high. This was actually the previous day's high. Look at this. The previous day's high is liquid. So you know what's above previous day's high, right? A pool of buy stops. Okay, there will be buy stops resting above the previous day's high. So we can mark that one out like this. Okay. And then, yeah, now this is a little sneak peek of what we're going to do. And then the final thing we take into consideration is timing. Okay, the next thing will be timing. So like I showed you, 8 a.m. London time or 1:30 p.m. my time. This was before daylight savings time. So this move could happen either during the London kill zone or London open. Okay, so it could happen like, you know what the kill zone is, right? That's basically the Frankfurt session. Okay, so we're only focusing on the Frankfurt session and the London setup more. So this will be a very consistent setup. Let's talk about that later. Okay, so look at this. So this is the London kill zone right here.
Are you starting from 7 o'clock to 10 o'clock?
Yeah, 7 a.m. Yeah, 7 a.m. is when London kill zone opens. This was this was February actually, before daylight savings time. I'll give you the times that I use right now. Okay, I'll show you. So if I set it to London time, where's London? Let me see. There we go. Yeah, see, 7 a.m., 8 a.m. So what happens? Let's play price forward. And the next thing we're gonna do is we're gonna sell it. Stop loss above the strong high. See that? 3.7 pips. And then we will be targeting external range liquidity. Okay, external range liquidity. I'll show you about this. So what happens? Not yet. There we go. Time is good. There it goes. Right at 7 a.m. Okay, right at 7 a.m. London kill zone clears out this pool of liquid, the previous day's high, Asian high, all of that cleared out into the strong high. Okay, into the strong high. And then what happens? There comes the drop. Okay, there comes the drop. That's it. Okay, so this is a very consistent setup. I'll show this to you later. So you can see what happened, right? Liquidity grabbed into the strong high time frame point of interest, timing. So those are the only things we take into consideration. Okay, so there we go. Taps, and then it starts to drop. Okay, then it starts to drop. So that same way. Now, what happens after this top hunt and this breakout structure? Another strong high gets created, right? Another strong high gets created right here. This will be another strong high because it has cleared out this liquidity. And it has broken structure. So this turns into a strong high. So once a strong high is created, what do? We go into the higher time frames to see what our point of interest is. So what do we have on the daily? Another rejection block, right? First we have an order block. Second, we have a rejection block. Okay, so how are we going to confirm which one is going to hold? Okay, now when there are two POIs, I prefer always waiting for confirmations from one of those zones, either one of those zones, or else maybe timing will be a nice factor. Okay, timing will be a nice factor. So look at this once again. Let's see at what time price is tapping into these areas. Not yet. There we go. The liquidity below it. Can you see that? Liquidity below the POI. Okay, liquidity building up. I think that's the Asian high. And there it goes. Taps. Yeah. This is it to London time. Look at this once again. 7 a.m. See that? Right at 7 a.m. taps into that, and then it starts to drop. Okay, so let's talk about the timing factor later.
Okay.
Sorry. Yeah, let's talk about the timing factor later. But yeah, that is what happens. See, taps right into it, and then it starts to drop. Okay, then it starts to drop. So that's another rejection block. Let me show you more examples because it's very important. Let me show you. Where else do we have there? Yeah, look at this one. Yeah, this was very clean. Where did this one tap into? Where did this one tap into? Right into this one. Okay, why? Why did it tap into this? That's the main thing. Liquidity above it. See that? Liquidity above it. And also, if you use a line chart, you'll see how this low right here is a strong low. See that? Stop hunt, breakout structure, strong low, liquidity, timing, there it goes. Okay, so that's the only setup we're gonna see. And also now, if you drop into lower time frames, look at this. This right here is a major trap. We can call it a major trap or whatever if you want to call it. Look at this. Higher highs, higher lows, higher highs. What will everyone expect? A higher low to form somewhere around here and a higher high, right? This is what everyone is expecting because why? The structure is bullish. Okay, so now maybe some people are waiting. Yeah, there we go. Supply zones, right? Order blocks. Buy it from here. Everyone's buying it here. Now look at this. This is why I told you price is fractal and it's just the closing price we're going to focus on. But once we switch time frames, you'll get a different view. Now on the 4-hour time frame, this is only a wick, right? This is only a wick. But if you go to 30-minute, what is that? An order block.
An order block.
See that? Yeah. On the 30-minute, it is an order block, a full-bodied clear one. And yeah, you can even refine it to this 50-minute rejection block that is in here. See that? The tiny one. Like I'm not going to do huge refinements. I'm not going to take this 4-hour rejection block and then move it all the way down here. No, that's too much. Just a slight refinement. Okay, just a slight refinement. So you can buy it with your stop loss below the 50-minute rejection block. So what happens? Okay, there it comes down, clears out all of this liquidity. Okay, so everyone that wanted to buy here, look at the reaction from that though. Why? Getting everyone hyped up. More and more buyers are getting in, chasing this move. Okay, so with this rejection, more and more buyers are getting in. But what happens? It taps and then it starts to fly. Like first, what they do is they clear out all of this liquidity. They induce all of those sellers into the market and then they go up. Okay, so that is what happened there. Okay, so yeah, let me show you. Let me show you some more. Same exact setup again and again. Okay, so let's see. Yeah, look at this one. So it's very clean. Yeah, look at this liquidity. You can see this, right? Equal highs.
Yeah.
Okay, equal highs. Like, are we gonna go into lower time frames and then look for POI in here and then sell it? No, right? We're gonna look for we're gonna wait for this to get taken out. Okay, we'll be waiting for this pool of liquid to get taken out. Okay, that is what we are waiting for. Okay, so now look at this. Now, what if we do this? Oh, liquidity, rejection block, sell it, stop loss above the rejection block. What if we do something like this? What happens? Stopped out. Why? Okay, because remember, once we spot the liquidity, we're not just gonna like for the sake of it being a very clear one, we're not gonna use this. Okay, we will always go into the higher time frames to pick our POIs because most people what they do is once they like when they start picking up POIs, they'll just go into the 1 minute first. Why? To get tight stop losses. No, that's wrong. Okay, to like once you spot the liquidity, you have to go into the highest time frame you have to pick your point of interest. Okay, let's talk about that later. But look at this one now. We have this pool of liquid, but on the 4 hour time frame, what do we have? Rejection block in here, right? So now, which one are you gonna trust? Okay, which one are you gonna trust? Like a random 1 hour rejection block or is the 4 hour? Obviously, the 4 hour, right? The 4 hour is stronger. Okay, so what we do is once we spot the liquidity, we're gonna go into the closest higher time frame point of interest, the closest highest time frame point of interest. Like there are times when we will be able to take like intraday trades from the monthly time frame. Okay, I'll show that to you later. Okay, but yeah, this is what happens. So now we have liquidity and this pool of liquid. So what happens? There it goes right into this. Okay, but also remember now your exits are more important than entries. Okay, anybody can get sniper entries, anyone can get there, but where are you going to pay yourself? Okay, so that is what's going to determine if you're going to be profitable or not. Because why did I tell you that? Now look at this. With this liquidity grab, okay, with this top hunt, this candle also closed above these highs. Can you see it? It has closed above these highs. So which means like once again, since it has closed above these swing highs, this low will turn into a strong low. Yeah, it has turned into a strong low. So now if I take a sell here, can I directly target the strong low? No. Okay, it might be a reversal zone, right? So what we do is we'll have to have safe targets. Now look at this once again. This 4 hour rejection block was a 1 hour order block. See that same exact thing. Okay, same exact thing. And so what do we have in here? Equal lows. Okay, liquidity. And on this strong low, what's the point of interest you have? Rejection block once again. Okay, so I did not take the sell. I only took the buy. Look at this. So we can buy it right here. We can have our stop loss below the strong low. Okay, we can have the stop loss below the strong low. Look at 3.7 pips. Okay, 3.7 pips. And what happens? There comes the drop. Okay, there comes the drop right into this one. Okay, right into this one. But look at this now. Now, once again, can you see how the bearish candle closed below these lows? Use a line chart. You can see how that high turned into a strong high. Can you see that? Once again, it turned into a strong high. So if I'm taking a buy here, can I target the strong high? No, right? That's wrong. That is wrong once again. Okay, so now we know that, yeah, the cells are already in charge because why? Once again, the major breakout structure is bearish. Okay, and the counter trend is also turning bearish in these areas now. Okay, so which means they're gonna drop into the external range liquidity. So the buy that we're gonna take is, yeah, it is a risky one, but because it's not in line with the current market direction. But what happens? There it goes. Look at that. Like that's enough, right? That's more than enough. That precision is more than enough because you don't have to go into the lower time frames. You only have 3.7 pips. Okay, you only have 3.7 pips from the 4 hour time frame itself. Okay, now, yeah, I did not take the next sell, but yeah, since this high IT is a strong high, we can still expect this rejection block to hold. Okay, but why didn't I take this? Because no liquidity below it. Can you see that? No liquidity below it. So not a very high probability point of interest. But what happened? There it goes. Taps, starts to drop. Okay, starts to drop. So that's it. Okay, that is why, yeah, I only managed to take the buy. Look at this. You can see how clean that is, right? So that's more than enough. Okay, that is more than enough. So if you risk 1%, you have 16%. I don't risk 1%, but yeah. Okay, so that's that. Let me show you some more. And yeah, like I'm not gonna tell you these rejection blocks are always gonna give you that tap and run setup. Okay, no, sometimes you will take losses, sometimes you'll be in drawdowns, but as long as you know how to manage your risk, you don't have to worry about any of that. Because see, in here, of course, you would have got stopped out for sure because he didn't give you that snipe entry, but eventually never went above that high. Why didn't he go above that high? Because it's a strong high. Liquid taken, structure broken, liquidity below it, and there it goes. Okay, so it didn't give you the sniper entry, but yeah, eventually it dropped. Okay, so let's see some more. Yeah, see, even this one. That it tap into, right into this. Okay, right into this. Yeah, look at this one. This was FOMC actually. First thing, what is this low doing here? This is a strong low, right? Why is it a strong low? Because liquidity taken off from a swing low, and then structure is broken, not with the wicks, but once you got this body closing. See that? Once you got this body closing, we know that this turns into a strong low. Or use a line chart, you see it very clearly. Okay, you see the formation very clearly. Okay, now look at this. Now this day we have FOMC coming. Okay, so you know what FOMC is? It's high impact news. Okay, so now look what they're doing. They're getting, this is how they're getting prepared for news since 5 long days. What are they doing? Filling up all of these equal lows. Not only that, look how many people are getting trapped. Okay, so much of liquidity. Okay, so much liquid build up. So are we gonna sell here? No. Are we gonna buy here? No. We're gonna wait for both of that to get taken out. So now, since we know it's a strong low, we know that, yeah, news will push it higher, right? Now, this is internal range liquidity. So outside of this will be the external range liquidity. Let's talk about that later. So below the pool of liquidity, what can you look for? A higher time frame point of interest. Now, if I go to the 4 hour, what do we have? Oh, we have many. Why? We have an order block, first thing. Then we get a rejection block. And we have another one in here. So are we going to buy from all three of them? No, right? Like at the time you're getting the right trade, your account will be blown. Okay, so now what we do is now, see, once you go into the higher time frames, the guesswork is over. Go to the daily. What do we have? Just one rejection block. See that? Okay, so that's the thing. Once you go into the higher time frames, the guesswork is over. There we go. So now both of the other zones are irrelevant. Okay, because why? The daily is stronger than any of that, right? The daily is anyway stronger than the 4 hour. And then what you could do is, if you want to, you can then refine this into lower time frames. So yeah, I did a slight refinement of this into this one. See, not huge refinements. The original POI was here. I'm moving it here. Okay, like not huge refinement, just a slight refinement like this. And then look at this now, 11:30 p.m. my time. Sorry?
Is that a breakup block?
That's not a breaker. That is also a rejection block on the 1 hour time frames. Yeah, that's another rejection block. This is a breaker. This right here is a breaker, but this is a rejection block. Okay, that's a rejection block once again. Yeah, so let's see. Now see at 11:30 p.m. my time, that is when FOMC comes. So let's see what they're doing. Look at that. How many more are getting in, right? So many. Okay, with this right here, like what if you take this to be a strong high, stop on breakout structure? Once again, you're trapped. Okay, once again, you're trapped. So let's see what's gonna happen. There it comes. Right at 11:30. Taps, clears out the pool of liquidity, and then it goes in search of the next pool of liquidity. Why? First, they took out the sell stops, and then they go into the buy stops. Okay, so where are the buy stops? Above, sorry, above all the swing high. So there it goes. You buy at internal range liquidity, and then you exit at external range liquidity. Okay, so enter at internal range, exit at external range. Okay, so a very clean setup. You understand that, right? So that is also from the daily. I'll show you how to do the multi-time frame analysis later, how I do that. Okay, so let's see. Sorry. Yeah, look at this one. Even this tapped right into this. Okay, so these are opening prices. Once again, opening price now. Where do you think this tapped into? Let me show you. See, same exact thing. Okay, same exact thing. What is this? A strong high on the H1. Liquidity taken out. Swing low broken. Right? Swing low is broken. So this turns into a strong high. So like I told you, what do you do? Like once we find out a strong high, we go into the higher time frames to see what our point of interest is. Now on the 4 hour, it's not that clear. Okay, it's not that clear. So what do? Go to the daily. So what do we have on the daily? Yeah, there you go. You can see already what it is. We have the rejection block. See that? We have the rejection block on the daily on that H1 strong high. Okay, we have that one. And then now if you go back to the H1, what do we have below it? Liquidity, a swing high. Okay, strong high, higher time frame point of interest, liquidity below it. You can sell it like this. Stop loss can go above these highs around 5 pips. See, if you can place it above these wicks. Remember, the safe place for the stop loss is above the strong high though, but yeah, it's too much. So you can have it above these wicks right here. And then you can target, once again, the external range liquid that is getting created all the way down here. Okay, so yeah, if I remember, this did not tap on trading view, but if you factor in the spreads, you'll always get tapped in. There it goes. Yeah, taps, and then it starts to drop. See that? Once again, higher time frames. Okay, so higher time frame POIs are very important. The thing is, if we mark out a zone like this, do you think anyone will have an idea what this is? No, right? Just
Yeah.
some random wick. Okay, just a random wick. But like I told you, it's very important. Okay, like you'll have to always pick your POIs from the higher time frame because they don't actually care about the lower time frames. Okay, all they care about is the higher time frame. So we'll have to always understand that. Okay, so yeah, see, even this tapped into this. Even this tapped into this rejection block, but didn't give you that sniper entry. I got stopped out in here because a huge drawdown, 26 pips. Because anyway, I'm not gonna have a 26 pip stop loss above that high. Okay, so yeah. Yeah, look at the position from this. See, right into this. Taps, starts to drop. Okay, starts to drop. Let me show you. Yeah, this right here. In here, of course, the setups were very clean, very clean. Yeah, this was the previous range we had. This was the past week. And yeah, these setups, let me show you. Okay, like we had some very beautiful setups this week. Let me show you that later. Okay, but yeah. So now if we get back into this example, now you can understand this, right? Once we spot this liquidity, we go into the highest time frame we have to see if we have a closing price above it. So what is it? It could be an order block, a breaker block, or else a rejection block, and sometimes an imbalance. Okay, not all the time. I'll show you when imbalances work, but not all the time. Okay, so can you understand this so far? I hope it's clear. Okay, yeah. Now what could happen is, next the market might give you a retracement. Once it gets here, yeah, it might give you nice moves. Why? Because there are people who wanted to sell it here, right? Now, some people have already gotten in. Like now the market is going down, so you might get these lower time frame breaks and all of that. So once you get that lower time frame break, another set of traders will be expecting a move like this, right? A retracement back into that lower time frame block that was newly created, and then the drop. So what they would do is once it goes back up, they'll sell it, stop loss above that newly created high, and they'll target lower prices once again. So that way they can increase the risk to reward, right? So this is what the majority of the traders would do. We know that. Okay, this is what the majority of the traders would do. But what happens now? When enough sellers have gotten into this market, smart money will step in and then they'll start placing buy orders, right? They'll start placing buy orders. Why? To take out everyone that wanted to sell here. So now all of the stop losses are taken out, right? All of these stop losses are taken out.
Yeah.
And then what happens? Okay, then what happens now? This right here was not just a removal of the sellers. What else did they do? Now, if you look at market structure, what was price doing? Creating lower highs and lower lows, right? But now all of a sudden you have a move like this. What would people assume? Oh, that's a bullish breakout structure. Okay, so now let's look for order blocks in here, demand zones in here, pull out our Fibonacci's from here to here, enter from the golden ratio and all of that. But where are the stop losses placed right now? Below that low, right? Because why? They want to buy it here. Okay, they want to buy it here. So if you consider this to be a bullish breakout structure, there we go. Okay, that is the inducement. Okay, so that is not actually a breakout structure. It was only a sweep of internal range liquidity. Okay, so once we go into ranges, once again, you'll understand that the range we had was from here to here. So this right here was only internal range liquidity. It is not a valid bullish breakout structure. Okay, it was only a sweep of internal range liquidity. So now what happens? All the sellers gets taken out. Now buyers are induced into the market in the form of buy stops. See, that's the buy stops that were above this high. It is now activated. And now some traders will think, okay, we have a bullish break. They start marking out order blocks here, demand zones here, or else they'll try to pull out their Fibonacci's from here to here. They'll do all of that stuff. But now where are the stop losses placed? Right below that low. Right? This is where the stop losses are now because everyone wants to. Now, most of the traders are buying this market. So what happens? Quickly comes back down, might get into this area and give you little moves. So that way more and more buyers are getting in and eventually this is what happens. Okay, this is what happens. So the safest place for you to enter is above the pool of liquidity from the higher time frame point of interest like this. Okay, and also the safe place for the stop loss is always above the strong high. Okay, the safe place for your stop loss is above the strong high. But yeah, if you do not like the risk to reward ratio, if the stop loss is too big, you can have it above the point of interest, and then we can target external range liquidity. Okay, we can target external range liquidity. So that is how it goes. So yeah, now like I recommend you do this until you find consistency with this, because now once we do this, yeah, there are times when price wicks out, like wicks us out of the trade, and then it goes in our direction. So that
Mm.
happens sometimes, but yeah, like this is what I do. Okay, this is what